We have Arvind Sanger, Managing Partner at Geosphere Capital, who's joining us here in the studio. Arvind, thank you so much for taking the time out and speaking to us here at NDTV Profit.
Thank you. Glad to be here.
So, Arvind, we had you here about a few months ago. And of course, back then, things were maybe slightly different and still the same. At least as far as the political scenario is concerned, well, we now have clarity as to what we can expect as far as government policies are concerned. Continuity is what we are looking at. What's the way forward from here, considering some of these aspects?
Well, so let me take a global perspective and then let me come to the India perspective. Sure. So from a global perspective, we've gone through 2 or 3 rounds of will they or won't they in terms of Fed cutting rates. So, every new data point brings a new discussion. Today we'll get in USRs, we'll get the CPI, then we'll get the Fed rate decision, then we'll get the press conference. So there'll be some volatility around that. My view is, on a global basis, we're in a cutting cycle, but I think the cutting cycle is going to prove to be less deep than people expect because inflation on a global basis is going to prove to be more sticky than people expect. So that's the backdrop from a global investor standpoint when looking at risk tolerance. So my view is if inflation is coming down some, it may stop at 3, 2.8 and not go to 2. I don't really care. It's not the end of the world. Right. In that environment, how does India look? And I think you were talking about World Bank forecasts. Our assumption is, if we get 6.5, 7% GDP real growth, we get 11, 12% nominal growth. We're looking for companies that can grow top line at 15% plus and grow earnings at 20%. The biggest challenge that we face in looking at India right now is valuations are not cheap. So therefore, it's not a multiple expansion story. It's an earnings growth story. And finding those companies, and that's what this trip is about. Right. It was planned to come after the election so that would be out of the way, and then talking to companies and understanding, because it's not really the politics that's going to drive, as long as there's continuity, which there is, right. It's going to be individual companies and subsectors' ability to execute, and that's what we are looking at where we find opportunities.
Okay. Arvind, good morning, of course, and just wondering, can the Fed commentary lead to any kind of issues for risk assets by and large, if indeed they rule out rate cuts for the rest of the year? Is that baked in already? Because some people say that we expect only in 2025 and nothing in 2024. But if they formally say something to that effect or indicate something to that effect, could it mar risk assets by and large? If they came out that definitively, it would. But I doubt that they will put their neck that much on the line. They will probably say that it's data dependent, data is getting better. The question is dot plots, which is kind of where the rubber meets the road. And will the dot plots still show 2 in September and December, or will the dot plots show only 1? I very much doubt it'll go to 0 because there's not been that bad data. So that 2 or 1 can cause near-term volatility, but the reality is what's going to matter is the data. Today's data on CPI, next month's data, whatever. There's a lot of data that'll drive the decision. There's one thing that is really not getting enough attention. There's something called a Psalms rule, which says that when unemployment in the US goes up by more than 50 basis points, it is usually a sign of a recession. Unemployment has gone up over the last few months by about 70 basis points. So far we're seeing no signs. But let's not assume that we're going to get this immaculate landing, that we land at 2.8 and then the Fed cuts and everything is hunky-dory. There's a risk of a recession. So we don't know. But to your original question, I don't think the Fed is going to dump on the party in a way that would, I think Powell is very much market friendly in that respect. Got it. You raised this question around India and the valuations thereof. Always been expensive, right? So we never find a cheap, except for maybe the COVID lows. We never find India to be cheap. So No, that's not the history. The Indian market, you can see there are ranges of valuation, but in the last few years, you're right. Yes, yeah, yes. So exactly. Recent history is anything to go by. So my question is, if from a large markets perspective, India and the NASDAQ are the only games in town, will India, and maybe Japan, of course, will India continue to remain expensive?
I suspect, barring any major shocks globally, it should remain expensive, which is why we're not counting on a multiple decline.
Okay,
but we're not counting on a multiple decline. We're just looking for growth stories and finding growth stories which are not fully discounting that growth. Because right now you find companies growing at 25% earnings, trading at 50 times on a PE multiple. So that's not kind of where we're looking for. We're trying to find growth at a reasonable price, and that's the tricky part in India, finding companies that fit that bill.
Okay.
Right. Arvind, how much importance are you placing to the India interest rate trajectory at the moment in your anticipation here?
So look, it's clear that RBI, first of all, has done a really good job in terms of managing the inflation cycle.
Yeah.
So inflation has come down quite comfortably. But I think also RBI doesn't want to step out and be first to go in a global environment. Now, you've already had ECB, I'm sorry, yeah, you've had ECB go, you've had Bank of Canada go.
Right.
So somewhere here, I think there is room for the Fed, for the RBI to start easing. I'm not sure how quickly they'll do it, but I'm not counting on a huge easing cycle. I think it is good that RBI has remained vigilant, and now, of course, we have now monsoon, so we'll have to watch for that for inflation. But I'm optimistic that there is some support coming from there. How big, I don't know yet.
Right. And, valuations aside, just talking about growth, and if we could just consider the relatively larger names in the universe, the Nifty 50, do you think that growth can come through? Would it be single digit? Would it be double digit? Is there a possibility?
No, I think earnings growth, if we have nominal GDP growth of 11% or so, I think good private sector companies should be able to show top line growth of 15%. So that's not out of the question. And in fact, some of the better values actually lie in some of the large caps. And financials is one of the areas where we find some opportunities because, again, we had some short-term problems, loan to deposit ratio and other things. But if we are believing in this economic cycle and we're believing that the private sector is going to at some point take on the baton from the government, which has done a great job on infrastructure, then some of the banks will be important in funding that growth. And so therefore, the financial sector is one that has remained, at least some of them have remained somewhat laggard, and we see opportunities there.
Yeah, a bunch of mutual fund schemes also getting launched out there. So within financials, are you preferring the private banks because the valuation multiple within the PSUs have narrowed? Or could it still be a year of PSU banks outperforming private banks? I mean, the profit pool of the PSU banks has expanded dramatically over the last 3 years. So they're doing something right. Yeah,
no, I must admit that I've been favorably impressed by the PSU banks' performance, which is not something that they have had a consistent track record of doing. I think there's opportunities in PSU banks, yes, and finding the right one with the right trajectory. But I think there's also opportunities in some NBFCs. The RBI has been cracking down a lot on this arbitrage between the two, but there are opportunities in some of these sectors, which again, there are some that are coming out of problem areas and seeing opportunities to grow. So I think the financial space has so many angles to it.
Exactly.
That is not just ICICI, HDFC, SBI. There's also a lot of both public sector banks that you're mentioning, and there are some interesting NBFCs that I think could be interesting in this cycle. Yeah, so the ones that are coming out of hit, so it could be gold loan, it could be consumer finance, it could be housing loan. Yeah, almost all of those could be interesting. Yeah, okay, valuations are interesting. And just one follow-up before I hand it back to Agam. Non-lending financials, I mean, that's a story that's really come of age in India. Do you like that pocket? When you're saying non-lending, you're talking about fintech type of companies? Or even the capital market players, AMCs, brokers, the infrastructure providers like CDSL, CAMS, etc. We haven't looked at those. We're meeting with some on this trip, so I hope to have a better answer to that question. But look, the financialization of the Indian economy is on a strong, very strong trajectory. And therefore, finding ways to play the winners of that financialization. I mean, we actually, we've been big bulls on the commodity trading. So, MCX has done very well, but we didn't see how BSE with the options trading. Now, the thing that I worry about with a name like BSE, I have no edge, is that the retail participation is a little too frothy.
Right.
And whether the regulator, who's been cracking down on a lot of other things, might puncture the balloon, I don't know. So I prefer to play in less frothy areas of the market where things are not quite as go-go as they are in some of these corners of the market.
Yeah. Interesting. It's interesting that you mentioned that as far as BSE is concerned, because we have mixed views on the regulator and the allowing of a lot of these retail participants in derivatives specifically. But I'm going to come back to the objectives of your trip this time, Arvind. What are the specifics that you have in mind? What are you keeping an eye on for your plan here right now?
Well, I don't have any specific theme that I'm meeting companies across
Right.
a whole set of sectors.
Right.
And just trying to get a sense from companies in different, whether it's financials or it's consumer or it's tech niches in Bangalore or whatever, or auto related, just trying to get a sense from individual companies of their own positioning.
Right.
I'm not, and I may go stop over at one of the conferences to get a view on the macro of what's going on.
Sure.
But the whole idea is to get a pulse of not the macroeconomy. The macroeconomy is so big that I'm not sure that any one company can give you the pulse, but get a sense of where some of the emerging ideas might be, and more on the mid cap and a few large caps thrown in.
Right. And do you have an idea in terms of which of these areas and what sort of mid caps are you looking for? Perhaps sectors, perhaps things.
I think the whole renewable green technology.
Sure.
Try to find areas that could benefit from that. There's a lot of froth, right? There's a lot of froth on anything that I say. There's already froth. So but some of the NBFCs that are kind of been left behind that area, and then looking at some niche companies in chemicals related sectors which
Right.
have suffered. So trying to find different areas where there's not as much froth and trying to look at those. So there is no big theme in the portfolio, but
Right.
it's always useful when I come back from these trips. I get some ideas, and then today's Zoom world, people that I don't get to meet on this trip, I'll be following up with in Zoom calls in the future, and this becomes kind of a impetus for companies who couldn't meet this week doing follow-up calls. So I think the benefit of a trip like this lasts for 2 or 3 weeks in terms of continuing conversations.
Okay. I have one final question. You're sounding quintessential value. Where is it that you are comfortable with premium valuations?
I don't know. I mean, it's hard. In India, it is hard as a value investor. I mean, in my global portfolio, I'm buying companies with 10, 15, 20% free cash flow yields. In India, I have to take that hat completely off and wear a hat of what kind of earnings growth, and if it's 20% earnings growth, do I pay 25 times earnings, 15 times, 20 times EBITDA? It's kind of a different. So trying to figure out because the thing that I have to recognize, and this is part of the challenge as investors, we can get stuck in the mud with one viewpoint, is that with the liquidity coming into the market, we have to accept that there is a theme here which is not going to roll over, and therefore we have to play in that circumstance and find relative value without completely losing sight of the fact that sometimes things can get too frothy.
So Arvind Sanger,
No, I just had one more question on the froth. For the sake of our viewers, if you could just tell us about the areas where you see there's so much fraud that it's actually so risky. If you could just tell us about the areas where stay away from this.
I'm not sure that there's. I think mid caps in general have a lot of valuation. We were thinking that if consumer is going to be interesting FMCG companies,
right?
But they all trade at 40, 50 times earnings to start
Absolutely.
with. So I'm not sure if there is a recovery coming in consumer, how do I play it at 40, 50 times earnings, right? I mean, I'm chasing after rainbows at that point. So therefore, some of these areas are hard to chase after with the valuations that they have. You know, IT is it a value trap or is it cheap? Because at the earnings growth that they have right now,
Sure.
they're not cheap.
Right.
Right? For, you know, single-digit earnings growth trading at 20 plus multiples is not cheap. And I see a train coming down the track with AI. So finding those companies that might be able to, I'm looking at more, and one other sector I forgot to mention, healthcare. I'm looking at less international facing and more domestic facing.
Right.
So I'm interested in Indian tech companies which are doing something interesting in the Indian tech ecosystem.
Sure.
I'm looking at healthcare companies, not the traditional pharma companies, but the ones that are disrupting existing structures of distribution of whatever domestic. So I think that the opportunity is different than what it used to be before, which was these outward-facing IT companies, outward-facing because all the money was to be made overseas. I think there's Indian economy-based winners that could be very interesting.
Okay, well, on that note, we'll thank you, Arvind. And you mentioned 3 weeks to take in, soak in all this stuff. By that time, the budget will be out. Look forward to getting your insights around how you thought about India post-budget, maybe, from the US.
Sure.
Yeah, great.
Thank you.
Thanks for joining in today.
Thank you. Good to see you.